I'm Nick Brind, and I'm joined by George Barrow. We are two of the three co-fund managers of the Polar Capital Global Financial Trust. It was launched in 2013 to offer a low-risk way to invest in global financials, and as illustrated on slide 2, it offers a broad exposure to banks, insurance companies, diversified financials, and fintech. Slide 3 shows the performance of the trust since inception and the corporate action in 2020, when the life of the trust was extended indefinitely, subject to regular tender offers, the next being in June 2025. Performance is shown against our benchmark index, the MSCI Acqui Financials Index, against the Lipper Open-Ended Financial Sector Peer Group, as well as other equity indices. The following slide shows the performance over discrete calendar years going back to 2017. Why consider financials now? In our view, this is not GFC2, but it is a mini banking crisis. Consequently, valuations have hit historic lows both in absolute and relative terms. However, capital return remains underpinned by strong balance sheets and profitability, and the current contagion fears, we believe, are overdone in creating longer-term opportunities. There is structural growth in areas such as emerging markets and small and mid-cap banks, as well as fintech, and we believe the investment environment for the sector will be very different over the next 10 years in light of the higher interest rate environment. On slide 6, we show the improvement in banks' balance sheets over the last 10 or so years. And this raises the question, why, when banks have so much capital and liquidity, have we seen a number of banks fail very quickly over the last few weeks? The reasons for the failure of Silicon Valley Bank can be explained by weak regulation and risk management, i.e. not hedging its interest rate risk to offset large losses in its securities portfolio, while for Signature Bank, its exposure to crypto obviously unnerved depositors as well. Unlike the GFC, this crisis is not about toxic assets, as the assets on Silicon Valley Bank's balance sheet were for the most part US Treasuries, mortgage-backed securities, and very low-risk loans to private equity funds. The issue for them was they were technically insolvent as a consequence of the mark-to-market losses on their securities portfolio, and depositors saw that. Silicon Valley Bank was unique in that respect, but this fear then spread to other US regional banks, notably First Republic Bank, which along with Silicon Valley and Signature Bank were outliers in having a high percentage of uninsured depositors, who for understandable reasons have been withdrawing their money for larger, safer, too-big-to-fail banks like JP Morgan. Turning to Credit Suisse, we highlight on slide 9 the cost of insuring against a default, which rose rapidly in the lead up to its forced sale to UBS over the last weekend. Credit Suisse had become notorious for poor risk management and poor profitability. For example, its 2021 annual report had 12 pages dedicated to litigation issues. Bank investors would point out that Credit Suisse's balance sheet had close to 100 billion Swiss francs in capital that would have had to have been burnt through before depositors lost a single cent. Ultimately, however, Credit Suisse lost the confidence of investors and depositors, and they withdrew their money, and even though it was confirmed as solvent by Swiss regulators only last week, it was forced to sell itself to UBS, wiping out AT1 bondholders at odds with creditor hierarchy. Slide 10 shows the increase in 2-year forward earnings for the sector of banks, insurance, and diversified financials. Banks in particular have seen a sharp increase in their earnings over this period, reflecting the rise in interest rates, which has resulted in their net interest margins expanding and therefore their profitability improving, notwithstanding concerns around the outlook for growth and therefore loan loss provisions. On the chart on the right-hand side, we compare this with the movement in their share prices, albeit this is yet to be updated for the falls in share prices over recent weeks. And this shows that the valuations of banks and diversified financials have both derated, while insurance, which was a beneficiary of its defensive characteristics, had re-rated over this period. Slide 11 shows the asset quality trends of US banks. And what it highlights is the small increase in bad debts during the pandemic in 2020 and how this has fallen in consecutive quarters ever since. Recent results from US banks has confirmed this trend that shows no material increase in asset quality concerns outside some increase in delinquencies for credit cards, and some subprime lending for fintech lenders. I'll now pass over to George.
Thanks, Nick. So in terms of the macro outlook, clearly remains an uncertain environment. I think what gives us comfort is the level of household savings and corporate cash levels, which is giving a buffer in terms of rising rates. As you can see on the chart on slide 13, household debt service ratio has risen, but is not particularly elevated from a historic perspective. Commercial real estate continues to be an area that we are monitoring closely, but as yet have not seen a major pickup in any losses. In terms of capital return, we think it remains a supportive theme for the sector. Importantly, the ECB have stated this week that post events in the US and Credit Suisse, they are not considering restrictions on payouts, so we expect yields to remain high and attractive. In the US, we do expect some more regulatory tightening, but that to focus on more the US mid-cap space, where we have minimal exposure. In terms of emerging markets, at 21% of the trust, this is an area that we've added to this year, primarily to benefit from China's reopening and the support to the region. We don't see the same risks in terms of unrealized losses on securities portfolios throughout our emerging markets portfolio. India remains a core holding where we're seeing strong operating trends, and banks are funded primarily by granular retail deposits. Turning to insurance, which is the second largest subsector, continues to operate in a supportive backdrop where we're seeing strong rate rises, particularly within the reinsurance space. In terms of Asian life insurance, where the trust has exposure through AIA, Prudential and Ping An, virtually all debt is held in AFS, therefore it's fair valued and reflected in solvency ratios, which are strong. In terms of our fintech exposure on page 17, which is 6% of the trust, our exposure is focused primarily on payment companies and those companies that are mature, profitable businesses. So we expect the fallout from SVB to reinforce the competitive position of larger fintech players, and given limited financing needs for our holdings, do not view a material impact going forward. Turning to valuations on slide 18, the sector is now trading at record low levels in terms of both relative and absolute valuations. If we update the gold box on this chart, it would have banks below that table at 7.4 times, so at a record low level. Given that we view Silicon Valley Bank, Signature and Credit Suisse as outliers, we think there is now significant recovery potential in this sector. Coming on to the rotation that we've seen from growth to value since 2021, while we do acknowledge current market dislocation, if we have shifted out of a low or zero rates environment, longer term, this will provide a material support for the sector, and we would expect further mean reversion in this chart. In terms of the breakdown of the portfolio, banks remain the largest subsector at just over 50% of the trust. More recently, we have reduced our US bank exposure through reductions in our mid-cap space, where we currently have under 1% exposure. We have added more recently to fixed income, and we've seen some interesting opportunities given recent market volatility. We have more recently also trimmed our European bank exposure post events at Credit Suisse, but still remain overweight this space, where we continue to see a supportive backdrop from rates and high levels of capital return. So in summary, we see the sector at a very interesting juncture. It is trading at record low relative and absolute valuations. Balance sheets are strong, and we view recent events at Silicon Valley Bank and Credit Suisse as outliers. Earnings are being supported by a shift out of a low and zero rate environment, and we expect capital return to remain a strong support. So thank you very much for your attention. If you have any questions for the managers or the board, please email those to cosec@polarcapital.co.uk with the subject PCFT AGM. Thank you very much.